as we said yesterday, financial management is a process of decision making with the purpose of keeping the business on or improving the business. This is slide 25. I think you have shared this. This has been sent to you with the Excel file. Nisreen has sent it to you. Last week we said we have two types of decisions. Scenario screening, which says this scenario is better than this and this is better than that. And so we are ranking 2 or 3 scenarios, 2 or 3 or more scenarios, choosing what is the best of these scenarios. The other type of decision is a go, no go. We say, oh, we can chase this opportunity, we can chase this investment option, or no. It is of no value. We will see that the scenarios and the go, no go both depend on many parameters. So on the scenarios, scenario 1 may be good under certain parameters, scenario 2 may be better under different values of these parameters. And the same with go, no go. Go, no go, maybe go under certain business parameters and driving parameters, and maybe no go under different values of these parameters. Last lecture, one colleague said, do we have some Excel workshops? I said yes, and I think we shared with you one Excel sheet with three sheets, one Excel file with 3 sheets. Okay. So this is our sheet. Now we're talking to some colleagues who very soon will be financial analysts in some big companies. So let us pay some attention to this. This task that we'll be seeing together considers 2 options. One businessman has 50 million and he wants to compare 2 scenarios. First scenario is bonding in a bank, putting these 50 million in a bank with certain interest rate. Here on this table, it says 12% interest rate. The other scenario is making an investment, building some shop or buying some shop and running it with some annual revenues and seeing how much the total revenue in 4 years' time compared to the bank bonding scenario here. Okay, that's simple. So any one of us can have this option. He has some money under certain conditions. He may decide to go to the bank and put it in a bond for 3 years or 6 years or whatever with a certain interest rate, and he will calculate the end results of how much the bond has earned him at the end of the period. Another option is to invest it. Maybe, for example, if he's buying or running a mining project for recovering granite or marble or oxide for aluminum or phosphate or anything. So every model has some driving parameters that we will see right now. Okay. Okay, let's proceed. So option 1 is bonding, putting it in a bond in a bank. And this will be compounded year after year to become the 50 million after 1 year will become 56 with a 12% interest rate. I mean, this 56 depends on this. Notice that if we change, and that's the sensitivity, if we change the interest rate to 5, I change it here, and 56 is now 52 only. So, and the rest of the values, of course. So let's go back to 12 to see all the others. So with this scenario, at the end of year 4, the original 50 million will become 78.7 million. Okay. The original amount, the bonded amount is 50 million. So the return is the difference. Here's the formula. This is 1, 2, and 3 is 1 minus 2. So the net earning is, in this case, is 28.7 million. Is that clear? I hope we are following ourselves. Is that clear, colleagues? So this bonding scenario ends up earning $28.7 million. And this is related to 12% interest rate. This 28.7. If we say it is 10%, the interest rate is 10%, it becomes only 23%. So you know that this option is more favorable with the increasing bank interest rate. Okay. By the way, this is the table. This is the summary table. We have 4 cases, which is 0 interest rate, case 1, 5% interest rate, case 2, 10%, 12%. And this is the summary of the 2 options, bonding and return on investment. We'll come to these figures down the line. So if the interest is 0, the bonding value is 0. There is no return on the bank because there is no interest. For 5%, the bond earns 10.8 million. For 10%, the bond earns 23.2, and for 12%, which is the maximum, the bond earns 28.7. On the other hand, the investment, as you can see, the maximum investment happens with 0% interest, and the more the interest rate increases, the less the investment earning. And you see, because there is discounting. Now we see, I've seen this option 1. You see option 1 calculations now. Okay. We assume that the investment, this plant or factory for mining, for granite or bauxite or whatever, earns $15 million a year over 4 years. Okay. Now, the discount, this money will be discounted because we get it in future. So there is discount. At the end of the first year, the discounting factor, you see, it is 1 divided by 1 plus R to the power N. R is the interest rate and N is the period.
Hello?
Yes? Any question? Okay. Someone? Okay. Let's continue. If you have any question, please put it on the chat and we will respond to it. Option 2, We assume that 15 million annual investment return. This factory earns the owner $15 million a year. And this figure actually has a long story behind it. We'll see it also down this same. So the discounting factor, first year, 89%, second year, 80%. So the discounted cash flow, the DCF, the discounted cash flow would become less. So 15 years, which you calculate right now at the end of the first year, will be discounted to 13.4. The second year, the amount will be discounted to 12. Fourth year, the amount 15 million will be discounted to 9.5. Okay, so at the end of the period, the discounted value will be, and this is, as you said, the impact of time on the money. Time value of money. I mean, the real money is a figure, and the value of that is different. Abdullah Ibrahim. Okay. Amen. There is an assumption that at the end of the 4 year, the plant has a salvage value, 12 million. It still can be used for further production or whatever, a salvage value. There is a value of the plant. I mean, the investment is based on 4 years, and after that, the owner will stop the business. So he has a used factory, which we call it salvage value. Sometimes the salvage value is just a scrap, zero value, or 1 million, very marginal. Sometimes there is a value, and the plant can be continued running by some repairs and refurbishing. So we add up. You see this formula to the right? The total is the earned value, the discounted value, plus the salvage value. So the total is 57.6. And the original investment, the owner put 50 million. So the difference, the earning is the difference. So this amount is 5 minus 6. This is 5 minus 6. Okay. And again, all these numbers are based on 12% interest rate or discount rate in this case. So if we change, you see that figures will change. If we change it, sorry, I should be here. If 12% is 5%, let's see that the impact of this is much more. The return is 15 million. As the discount rate is reduced, these factors, the discount factors increases, and the discounted cash flow increases as well. So this is the sensitivity to the discount rate. Okay. So in this case, the return on investment is 15 million. Let's get back to the original 12%. So, which clearly, as we said before, the interest rate or discount rate, as it increases, it suggests going more to the banks and bonding the money. It breaks the investment, and the less the interest rate, the more good environment for investment. And that's why the big economies like Japanese or European, they try to reduce the interest rate as much as they can to push and encourage the people going investment instead of bonding the money in the banks. Now, let us compare. You see, I just want to see the summary table. So under 12% interest. You see this figure here, bonding 28.7. This is what we see here, right? There is it's the same value. Now, if we, and this corresponds to investing 7.6. 7.6 is this figure here. So under 12%, we have investment return 7.6 and bonding return 28.7. If we change this to 10%, now we see the bonding is 23.2, 23.2 here, under 10%, 23.2, and the investment option, if we change this to 10%, we get 9.5 million here in this table, 9.5, and so on with other values of the interest rate. So let us see the graph up there. We're trying to find the favorability of each scenario and the break-even point when both scenarios are the same. Okay, we see here the values. The red line is the bonding in the bank, which starts with 0. If the interest rate is 0, the value is 0. If the interest rate is 5, the value is 10.8, and so on. This is the red line. The investment with 0 interest rate, maximum investment 22 million, and it goes less as the interest rate increases. It goes less, like these are the values of the table. Here, the break even is when the two curves intersect at this point. If you see this is 5%, this is 10%, it looks like if it is 6%. That's why on the chart title, investment options and break-even point, which is around 6%, which means that before 6%, the investment is better than bonding. Investment is better than bonding. After 6%, the bonding, red line, is better than the investment. See, it's clear. So this is the break-even point. Before that point, the situation changes. Investment, the lower the interest rate, the better the investment, better than bonding in the bank, and the more interest rate, the better the bonding than investment. I hope that is clear. I tried to make it clear. Clear, my colleagues? I assume no objection. I assume that it is clear. I hope it is clear. Do you have any questions before we move on? Okay. At this point, I decided to make what if scenario. So the other sheet that you also have, this is the first what if. This 15 million to me is a big story. So the what if scenario, first what if scenario, plays with this Where are we here? So this is the same table before, just focus on this part here. This part here. So I'm not sure if, okay. So this is our part indeed. This is our part indeed. Okay. Someone said, is it this part? No. I'm trying to find the exact part. Okay, okay. I think I was meaning to this file. You see, it's the same. Bonding option is the same numbers, same results. But for the investing, I see that someone said, Mister, you have assumed $15 million each year, but it might not be the case. It might be different figures. For example, here, first year, 17 million, second year, 16 million, 14, 13 million. Total is the same, 60 million actually, total 4 years is the same. And previously it was 15 million, 4 years is 60 million. But it tends to be higher at the beginning and goes less and less until the end. Why is this happening? It's simply like that. If you ask yourself, what is the revenue? How this figure comes? And the result is here. Look at this. The revenue equals the sales minus the costs. Okay? To run the facility, the owner has to bear some costs of raw material, of spare parts, of maintenance, of people, energy, power, water, and so on. These are costs. And the sales. The sales is the production amount times the price. If I'm producing X ton, the ton price is this amount. So we see the sensitivity here. For production, we have the production depends on plant conditions. At the beginning, the plant is new plant, so the production could be higher than 1 year or 2 years later. So this is one sensitivity. Other sensitivity of the production is the market demand. Maybe the plant is okay, but the market demand has reduced due to some other options for the consumers. So the production is no longer needed in the market. Competition. Maybe there are new producers, there are new suppliers of this utility, of this product, marble or whatever. So the competition actually cuts down on the plant production. So these things can change the production rate. Definitely the plant production goes less and less with the plant conditions. The market demand, someone can argue it may increase. Indeed, it's a risk that can turn to an opportunity. It may increase. and competition as well. Maybe there was another plant that the owners shut down the plant. So the competition is less and the market demand increases as well. So these are factors. The figures that we put, 17 million, 15 or whatever, are sensitive to these conditions. Pricing. Pricing, we have three options of pricing: cost-based pricing, market-based pricing, value-based pricing. We'll see this actually at the end of today's lecture. Inflation and purchasing power. Maybe the pricing has to respond to the reduced purchasing power, such as what's happening in this case in some markets like Egyptian market. So this is another driving factor on how much the owner can sell to ensure that the people can buy the commodity that he is offering. Cost-based depends, as it is named, it depends on the costs. The owner calculates the costs, all the costs, and then add up a markup. If the cost is, say, $10 per piece, the markup could be $3, so the price will be 13. Cost plus markup. So this is cost-based. Market-based is, you see other service providers or product providers on the market, other suppliers, let's say, and see how much they offer. If they are selling the same product, same quality, same everything for $10, you need to think of $10 or 9.5 or 9. So you'll be responding in order to ensure your market share. You have to see what the other product suppliers on the market prices, so that you can consider. You cannot see that the market is providing, other suppliers are providing at $10 per piece, and then you price for 12. You will not get a market. The other people will leave your product and go to the cheaper product. Value-based is another case where actually if you are unique on your product, then you have a big chance that the people are buying value and they are willing to pay more for it regardless. So the pricing and production reflects the sales. Then we go to the costs. The costs cover raw materials, manpower costs, utilities, power, water, blah, 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 maintenance, and so on. So you see, this figure is a very complex figure and sensitive to many parameters. And that actually this figure, it was on the other sheet. It was on the other sheet. I did not work consistently. On this model, on this sheet model, actually, it was where we considered the plant condition, the market, and of course, you will have to run and have to consider risk assessment for various years to come, considering the market, consider the competitors, considering the costs of the market, and so on. So here again, these values, 17, 16, and so on, are discounted to become, for 0%, it's 0, but for 12%, it will be much less, discounted to 15, and so on. Then the total will be this. And then another parameter, which is the salvage value. Is it 12 million or could be just a scrap, some scrap steel of the plant and so on? So it may be down to 2 million. So the total is 46 plus 2 is 48. And the original investment is 50. So it's less. So the net return is minus 1.8 million. It's clear that under these conditions, if the interest is 12%, and the salvage value is 2 million, the investment is not worth actually. But if as or the original base case, actually you put 12% salvage, it is positive. Definitely, and this is a theoretical assumption, that it will be earned at the end of the project. No, definitely we offer the plant and people come and survey and qualify and assess the conditions and offer and negotiate and maybe take 2 years or so on to make a deal. And the 12 million after 2 years will be actually discounted. So all this actually has to be considered. But as you see here, if it is 2 million, the curve is up. Curve is up. I don't know what will be. Here is negative. Here it is negative. This is the negative value under 12% interest rate. As you see, this is the negative value. Here is the zero, this is the negative value. So the investment is not good at all under this high interest rate. And definitely it's more safe to go to the bank bond, which is this red area, which is much better. And you see here the break-even point is less than 5, maybe something like 4 or 3.5%. So I hope that the message is clear that the scenario is not absolutely good. It's good under certain values of the driving parameters, and it's less good or less attractive under other values of the thing. So this is how to apply the ranking of various decisions and make the final conclusion and decision based on the results and the break-even point. Now, we go to the second type of decision, which is go, no go. Here is a payback period. A payback period is a parameter where the owner say, I want my investment to be collected after a certain period. 2 years, 5 years, 6 years, or whatever, depending on the industry and the amounts we're talking about. So we make the analysis and calculate the payback period and say to the owner, this is the results, and he is either okay or say no. So this is a go, no go situation. Here it is. So this is the analysis. Year 0, year 1, 2, 3, until year 5. Bonding interest rate is 5%, or let's call it interest rate. The investment is 50 million. First year, it is compounded to 53, second 55. So after 5 years, it becomes 64. Okay. The return on revenues. So the value itself increases, and there is annual revenues, 15 million, let's say fix it. So the total is 5 years time, 75. So total revenues is these 5 years amounts, 75 million. And the original investment is 64. So the original investment increases year after year, or like the blue curve. And also the investment increases gradually like that. The point where the revenues equals the investment is the payback period. Is the payback period where the owner can consider, is it acceptable for him after 4 years in this example to go on this decision or not. Most owners avoid longer payback period because the parameters, the forecasting of the parameters after some time is maybe rough, is not really accurate because the market conditions and risks and the global economy and the geopolitics and many other parameters make the forecasting less accurate. So they don't want to run into the unclear or vague area of forecasting. It may be better or it may be worse, but they want to have a short payback period where the forecasting is somehow accurate to a certain extent. Okay. Any questions? Any notes? Did you have any chance to check this Excel sheet that was given to you? Did you find any notes or any wrong numbers? Now, there was another Excel sheet that we might show you for interest. This one. Where is? Ah. Okay. This curve is a typical cash flow for a project. The other model actually was supposed to be for a company, but this now is for a project. Very common, the project cash flow curve. This course, by the way, okay, someone on the chat. Clear, thank you very much. Walid said it's clear. I'm glad about that, actually. You see, this is the cash flow curve, as I said, from the beginning to the end. The cumulative curve, the red curve, all the time has positive values. And this is the end. We earn 100 million. We'll go to this exercise in more details, actually. This was a model where the contract price is 500 million and the project cost or contract cost was 400 million. So the markup is 100 million. So at the end of the day, the owner collects total 100 million, which is the markup. But there are things actually that affect this curve. For example, Here are some driving parameters. Here is the contract value or contract price, 500. The cost is 400. The cost over the price is 80%. The advance payment is 10%. And the interest rate is 5%. And so on. So if you see this advance payment, we change it, you'll see these calculations, the value of work done and the cash in, which is the revenue, which is total up 500 million at the end, and the cash out, which are the costs. Here, it should end up 400 million to the right. Here it is, these amounts. So here is the total value of work done, or cash in is 500, while the cost cumulative is 400, and the difference is 100. But let me freeze here. View. Can't see from the. Okay. View. View. Okay. Okay. Let us reduce the zoom and see. I want to show one simple, clear thing. Okay. So this is the curve, and you see at the beginning there is a big amount. There is 10% advance payment. If this 10% is made as 5%, you see the curve changes actually, and we started some negative cash flow. This area here, month 10, 11, 12 are negative cash flow area, because actually the costs at the early period outweighed or increased more than the advance payment. If we further say that the contract was negotiated for 0% or zero advance payment, you see, definitely there is a big area of negative cash flow from the beginning until month 70, after which it will become positive cash flow. And at the end, he earns 100 million, which is the markup, the difference between 500 price and 400 cost. However, this project has two problems. This negative cash flow means that the contractor need to go out for funding. He need maybe to go to the bank and take some loan to be able to spend on the project over this period. After that, he will start making positive cash flow, and he can improve the situation. This is it. The other point is that these installments, any series of installment has a net present value as one key parameter in evaluating the investment. Let's go back to suit the contractors. Okay. Here, this figure is the net present value, which is 92.7. Numerically, we said that at the end of the project, the contractor takes 100 million, but the value of this 100 million is not 100, it is less due to the time value of money, the impact of time on the money. So there is discounting of various future amounts that he gets on these net cash flow amounts, which makes the value of the figure less than the numerical value. So this is the case. Here is one value. By the way, the net present value is a function on the Excel which asks you for the percentage discounting and the various amounts. Here, yeah, you see it is monthly net cash flow and the percentage that you define here. The percentage. This rate, actually. So actually, remember this figure here that we said 92.7 under a different interest rate, the figure changes. If the rate is 10%, not 5%, let's see how the figure is. 10% should be less. It is 86.9 million. So it's maybe 5-6 million less than that, which means that under high interest rate, the investment is not good. Going on the contracts and taking all this hassle and risk and so on, it's not favorably. Numerically, I say my markup is 100 million, but the value of this 100 million is almost 86 million as a net present value. So I want to show these two tables. I will share it with you, and you can go through the thing. One other thing on this table actually is the payment term. The payment term. Let's see how I put the payment terms. If you see, indeed, there is a summation on other, okay, U29. U29. Okay, here is hidden rows here. See how we developed it on hide. Our planning engineers are interested in this. This is various project activities, engineering, major equipment delivery, other equipment, bulk material, civil works, structural steel. So these are the parts of the project actually, and this is the phasing of various activities. These are the amounts in million, in thousands actually, and the total is actually the price is 500 million. So each one of these is phased according to the project phase, and this is actually what this is one trick of presentation. I don't want to show all these details to focus on the summary things. So these are the total progress monthly, summing all these items that we have shown that were hidden. And then cumulative, we go to the next line here. So this is the cumulative. The cumulative should end up with 500, as we said. Yes, after month 32. So this is the cash in. The VOUD is the cash in. The cash out is the cost. The cash in. And I think this is a progress curve amount, U40. Yeah. U40 times AF. Times AF, sorry, AE9. AE9 is the ratio of the cost to the price, this figure. Simply, it says that it's 80%, which is 400 million divided by 500, which means that for every dollar the owner takes, he spends $0.8. That's it, which is the ratio of the cost to the price. So this is how these figures come. It assumes that these same amounts are costed at 80%, this 80%. So while the owner earns $0.4 million, he pays $0.4 million times 0.8. This is the formula here. This is the formula, and so on. Every value of work done earned here, we multiply by 0.8 to get the costs here. Okay. There is one exception point here, is the 50 million. 50 million is the advance payment. 50 million is the advance payment, which is 10% of 500. So this is what makes the cash out curve. And then to get the net curve, you subtract the cash in minus the cash out to get these values, which are shown on this graph. This red point is the net values here. So first month is I think 48 point something. Second month is 47.6, and then it comes down for this period. The point is that the contractor at the early months spending, but takes the money maybe 2 months or so due to the invoicing cycle and approvals and so on. So here, if you see, this is the value of work done. When does the owner gets this value? Depending on the payment term, actually. Here, actually, assumes that here, look at this here. This is the value of work done, and he gets it here, cash in. So he spends the money in month 1 and gets it in month 3. And that's what the problem with the contractor is, that he keeps spending and wait for some time until he collects back the payment from the owner, and so on. So in any case, after some time, the situation improves and the net cash flow will be positive. First period is negative, -2, -12, blah, 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 blah. And then after some time, it becomes positive, and the cumulative curve recovers to the positive area. Let me see. Please, where can I find the course and files after finishing? Where can I find the course and the files after finishing? The answer is the full files, the Excel and the PowerPoint will be handed to all participants. We are actually on a two free lectures just to show you the outline of the course and the issues that we'll be addressing. And we are open for your suggestions. I think after that, we will continue with those. Yes, please, where to find the attachments. The attachments, you have been, Sreen has shared to you, I'm not sure if you received it or not, the part of the PowerPoint for the previous lecture and this one, and these Excel sheets as well. Anyway, these sheets that we have been seeing now and part of the PowerPoint will be shared with you. I hope tomorrow you will receive it. I'm not sure how to communicate with you. Previously, there was a group. Let me cross-check to make sure that you will receive this material. I'm sure it's fair for you. Actually, you may need some time to have more close look and check the calculations, check the cells. What has been said. السلام ورحمه الله وبركاته. لا انا قلنا فور ذا فيرست اللي احنا اتكلمنا عليه هبعته لك النهارده يعني. فبس ده I have to say apologies. Okay, we're back. Are we back? Someone say yes. Okay. Okay, colleagues. Okay. So I was given to believe, I assume that you have shared these two files. So I was I'm sorry for that. It would be much easier for you to follow up if you have seen these Excel sheets before. Yeah. As you can see, the file I'm using has more sheets, but I just wanted you to focus on this. More sheets actually will be going over with other sessions of the course. So I promise that Nisreen will share with you these things. I'm sure you have, every one of you has posted his telephone or WhatsApp number or so on, so that we can share with you. Normally what happens is we create a group with all the participants, and we share all the communications in this WhatsApp group. I see what we can do in our case. Okay. لا خلاص شكرا.
خلاص تمام كده.
مبدئيا تمام التمام. طيب انا لو عملت ستارت سكرين شيرنج على، طيب محمد
كده ظهر تمام.
تمام. طيب اوكي. خلاص موضوع الحل. Apparently there was some problem with the internet, so apologies Muhammad, Muhib, Imad, عبد الجواد, Shihab, Ramiz Morris. Ramiz Morris, where are you, Ramiz? Which country? Ramiz, we need to communicate. نور الدين, محمد الفيافي, Ahmed Saad, and so on. So we hope that Nisreen will make a group on the WhatsApp and share with you these two files. So now, before we move on, do you have any clarifications, questions, or anything? I mean, I tried as much as possible to make it simple for you to test how we build the model, how we qualify or check or ensure that the assumptions are okay. Okay, thank you very much. But I'm still open. What I write, I normally understand, but my message is not me understand, but make you understand it. Indeed, I had actually some extreme dream that maybe at the end of the course, I can add to your knowledge and your practice on this financial management areas, that one of you may volunteer to give us a brief session playing the role of an instructor. I hope it's very, very interesting actually that at the end of the course, I feel that I have passed on some knowledge and some practice to the people, that the point where you end the course is different from when you started the course. Back to the value of the annual revenue, which one case we assumed equal 15 million, and then said, what if it is different? In any case, actually, the message behind this figure is there is a lot of cost estimation tasks behind the financial management, cost estimation, and also there is a lot of risk management tasks behind it to qualify the figures. As we always know, the quality of the input defines the quality of the output. The quality of the output may be a recommendation to the business owner, to the investor. Yes, we can go on this. However, that recommendation could be wrong because the assumptions and the accuracy of the figures and the quality of estimation and the risk assessment was not good enough, so that we made a wrong recommendation to the business owner. So that emphasizes and stresses the need to check all the figures, check all the assumptions, and make sure that they are as correct as we can. And that's also, we need to make some sensitivity. Check the basic assumptions and see what if this figure was wrong? What could be the consequence? What it could be overestimated by 20% or underestimated by 20%. We should be asking these sensitivity questions to verify and ensure that our end conclusion is valid, is true. Then we also develop cases. We develop a base case, and then the best case if the things go favorable, and the worst case if the things goes worse, such as the escalation, the interest rates, and so on. These things we try to assess the impact to reach a best case or a worst case. Okay, thank you. Here is one, I think, from 966, which is Saudi. Yeah, okay, Nisreen will take care of that. Please make sure that you share with Nisreen your WhatsApp numbers, so that maybe tomorrow, inshallah, you can receive these files. We move on. We have gone through this before yesterday, selecting the decision criteria, data collection, scenario modeling, estimation and forecasting, risk assessment, what if analysis and sensitivities, handling borderline cases, making the final decision and implementing the decision. Yesterday, we have explained the compounding and discounting. Here is the compounding formula, and here is the discounting formula. By the way, the ratio, the interest rate, are in this compounding might be different than discounting. They may be also the investment, the interest used on investment may be different from the interest used in bonding on the bank bonds. Interest rates and inflation. Interest rates should generally cover more than inflation. We mentioned for the compounding to be valuable, the interest rate should cover the discounting and leave some margin more for the investor. Otherwise, if you invest and lose by discounting, the end results will be zero. Here is an example, numerical example, time value of money. Let's take a break of, let's say, 10 minutes and then come back to wrap up. If we have any question, did we can send it in WhatsApp group? Okay, definitely, my colleagues, you can, if you have any question, you can pass it to my email, please. My email is on the first page here. I'm glad to share it with you here. This is my email here, fawzi@gmail.com. So you please feel free to just write it down now, and tomorrow this part of the presentation will be given to you, but let me make sure that you have my email. Any question, I will be glad to receive your questions starting from when we finish this. Okay. Someone said there is no sound. Why there is no sound? I'm okay. Maybe it's a matter of internet issues, either on your side or my side. Otherwise, I can see other colleagues are sharing my voice actually. So check your email connection. Apparently, my condition is okay, is healthy. So you've seen these two graphs before. And this is the case where the interest is zero, which makes compounding of zero and discount of zero. So actually, this case, you say, go and invest your money outside the bank, which is the best investment environment, actually. We said, let's take 10 minutes break and come back to wrap up. Okay. طيب يعني السلايد هنا بتكلم على some project model. This is actually the one that we have seen on the Excel sheet. The project sale price 500 million and the cost is 400 million. Terms of payment, advance payment 10%, progress payment based on physical progress, fixed costs based on level of effort, fixed costs like the PMT costs, payment 30 days from invoicing, variation settled for starting the work, performance guarantee bond 10% to be released 1 year from provisional acceptance. From the owner perspective, the owner may be running the following businesses: hotels, hospitals, transport facilities, power stations, water, oil and gas plants. So we will cover the life cycle economics, life cycle financial parameters on these cases. The microeconomics of these companies are managed to ensure competitiveness and business continuity. For hotels, the cost per bed night. For hospitals, the cost per operation or cost per visit. For transport facilities, the dollars per mile. pump stations, the dollars per megawatt hour. For water and wastewater, the dollars cost per meter cube. For oil and gas, the dollars per barrel oil. These are the key economic parameters. The contractor cash flow highly depends on payment terms, 4 weeks or 6 weeks. Big difference actually. On the net present value at the end of the project, it may end up with 1 million or 2 million on this condition, 4 weeks or 6 weeks, which is not small, $2 million on this contract, on this size of the contract. Actual application and achievement of the above terms. In reality, many times the actual payment is achieved maybe longer than the terms on the contract, which even make the financial situation of the contractor worse. The procedure of disputed amounts. In many cases, the rough owner performance say he'll hold the whole invoice, while it's not fair. It's fair only to make a retention on the disputed amount and release the full invoice. Just retain the disputed amount, not the whole invoice. The percentage of advance payment, milestone definition, and interim payment. Sometimes the milestones are shaped to be upfront for the good of the contractor, or back end for the benefit of the owner, and the contractor will suffer. Application of proper earned value analysis and physical progress. That actually depends on how we approve the work and what the percentage and the weights of each element of the work that actually define the ultimate value that the contractor is entitled to earn. The application of the interest rates, financing arrangement. Is the project self-financing, especially as we've seen, if you have a good advance payment, or if the project has to go for loan, if there is no advance payment, and get cash flow period that the contractor should finance. So we go out for financing. This is the case actually. This is the case. If you have advance payment, the cash flow actually will always be positive like that. This is the zero axis here is negative cash flow periods actually, because there is no advance payment. So it depends actually on negotiating good contract terms. The whole situation changes. The less the interest rate, actually, the more the net present value as this curve, and we have seen actually the sheets changing this percentage and the effect on the present value. That's an example of the owner, actually the owner model, cash flow based case. The cost data. The cost data is the EPC contract, which is 500, the same value that we've seen on the contractor side. Say the contract value is 500, so this is a cost value for the owner. There are other owner costs such as land acquisition, pre-project studies, earlier studies, and site investigations. Owner furnished equipment. Sometimes the owner is providing some systems, some high expense equipment. Setting up of the company, permits and licenses, PMT costs, asset revamps. Subsequently, during the operation, the plant needs some repairs and revamps. So this is the grand total of all these items. Here is some details on the owner model. So here is the cash flow for the owner model. Actually, the owner may take 4 years developing the project, such as this one. So we'll spending. So the curve goes here. And then starting production in year 5, you'll start earning. So the curve will start to go higher. The break even is after 8 years here, when the owner has recovered all the expenses. And then there is net profit actually here, starting from year 9. Year 9. This is typical. If this model could be for an oil field, a hotel, a power station, a water treatment plant, or a hospital, or anything like that. That's from the owner perspective. Of course, the contractor's perspective is only 3 years or 5 years the life of construction of the project until start up and hand over. But the owner, on the other hand, continues long life, many years after the completion of the construction and startup, which is the operating period, which may be 15 years, 20 years, or even longer for power stations and oil fields and so on. Many cases actually. Discounted cash flow. I've said that before. Do we have any suggestions or clarifications? In any case, I said, please use my email at the beginning of these slides and send me any clarifications, any suggestions, and I will be glad to feedback and answer you. Okay. Walid, Yusuf Fauzi, all of you are welcome to make your questions. And I think this is the second free lecture. And those who wish to continue, I think they need to contact Nisreen or join the link for booking the course. For now, if we don't have any questions, I wish to say thank you very much, and I wish to see you on your clarifications and to see you on the next lecture, which will be next Wednesday, same time. Maybe I suggest to make it 10 minutes past 6 because Salat al-Maghrib actually is coming close to 6. So let's make it 10 minutes past 6 in principle to give the people a chance to make Salat al-Maghrib, inshallah. Okay. For now, please ensure passing your contacts to Nisreen, your WhatsApp numbers, so that she will share with you these files. Thank you very much. Assalamu alaikum.